Hello fellow traders. Today is another of many videos where we cover things in the markets. Today we cover understanding earnings multiples in trading and investing by Pajama Trader. What are earnings multiples? Earnings multiples are a financial valuation tool. They are used to assess the desirability of a stock or investment. These multiples provide insights into relationships between the company's stock price and its earnings. They are a fundamental part of financial analysis, helping investors to make informed decisions. What are the types of multiples? Common types are PE, price to earnings, and PEG, price to earnings to growth. PE compares stock price to earnings per share, EPS. PEG considers growth potential alongside the PE. PEG below 1 is often seen as a good sign, indicating an undervalued stock relative to its growth. Microsoft will be the example of this PE ratio. PE, Microsoft's stock price, divided by Microsoft's earnings per share. Example, if Microsoft is trading at $200 a share and its EPS is $5, the PE ratio is 40. The lower PE may indicate Microsoft's stock is cheaper, but not necessarily better. Interpretation of the PE for Microsoft. High PE for Microsoft suggests investors have high growth expectations for the company. Low PE for Microsoft implies that Microsoft stock may be undervalued, but could also be a value trap. The PEG ratio for Microsoft. PEG, PE ratio divided by Microsoft's annual earnings per growth rate, provides a more comprehensive view of Microsoft's valuation considering its growth prospects. A PEG ratio under 1 is often considered a good sign. Using earnings multiples with Microsoft. Earnings multiples are useful for analyzing Microsoft in the following ways. Comparing Microsoft with other tech companies. Evaluate Microsoft's growth prospects in the technology sector. Identifying potential value or growth investments within the tech industry. What are some of the limitations of earnings multiples? Earning multiples alone do not offer a comprehensive view of an investment. Market sentiment and external factors have a significant impact on the stock price and performance. It's advisable to use earnings multiples alongside other analysis tools for well-rounded investment evaluation. Microsoft's ratios. Microsoft has a PE, price to earnings ratio of 40 and a PEG, price to earnings to growth ratio of 1 and 1. The PE ratio indicates the stock's relative price to its earnings. The PEG ratio factors growth alongside the PE. Choosing the ratio. When evaluating the Microsoft, a PEG at 1 and 1 suggests reasonable pricing considering its growth prospects. Both ratios have their merits. The choice depends on your investment goals and risk tolerance. Evaluating the ratios. PE, price to earnings. A PE of 40 implies that investors are willing to pay $40 for every dollar of Microsoft's earnings. A higher PE suggests higher growth expectations. PEG ratio, price to earnings to growth. A PEG of 1 and 1 means that considering Microsoft's growth rate, investors are paying relatively a reasonable price for the company's expected growth. A PEG under 1 is often considered a good sign, indicating that the stock may be undervalued relative to its growth prospects. Comparing the ratios. In this case, a PEG of 1.1 suggests that Microsoft's growth potential is fairly priced, considering its PE ratio of 40. A PEG below 1 generally implies an attractive investment, but a PEG slightly above 1, like 1.1, is still considered reasonable. Which ratio to choose? The choice between PE and PEG depends on your investment strategy and risk tolerance. A lower PEG often indicates a more attractive investment, especially if you're seeking growth stocks. However, a PE alone doesn't account for growth prospects, so PEG provides more of a comprehensive view. The Pajama Trader trade. The Pajama Trader is an individual investor who prefers trading from the comfort of their home, often in their pajamas. They specialize in the energy sector and have a particular interest in ExxonMobil, ticker symbol XOM. Earnings multiples in ExxonMobil. Initial research. The Pajama Trader researches ExxonMobil and notes that it currently has a PE of 15, indicating that the investors are willing to pay $15 for each dollar of earnings. Earnings growth assessment. The Pajama Trader believes that in ExxonMobil's growth prospects due to its new projects and rising demand in energy. PEG ratio calculation. They calculate the PEG ratio by dividing the PE 15 by the expected annual earnings growth rate for ExxonMobil, which they estimate is 10%. The result, PEG ratio of 1.5, indicating that the stock may be slightly overvalued relative to its growth prospects. Trading strategy. The Pajama Trader decides to implement a mixed trading strategy. The Pajama Trader buys 1,000 shares of ExxonMobil at $50 a share, representing a $50,000 investment. This is part of their long-term growth strategy. Along with that, the Pajama Trader sells covered call options on 500 of their Exxon shares at a price of $55 with an expiration date in 3 months. They earn a premium of $2 per contract, bringing in $1,000 in income. The Pajama Trader keeps a close eye on ExxonMobil's performance and earning reports. They adjust their options positions as needed, particularly as the expiration date approaches. Review and adapt. Over time, the Pajama Trader continuously reviews their strategy and adjusts their positions based on changes in ExxonMobil's fundamentals, market conditions, and earnings multiples. If ExxonMobil's PEG ratio changes significantly, they might consider their position and adjusting their option strategy accordingly. The Pajama Trader combines fundamental analysis using multiple earnings, PEG ratio, with a mixed trading approach that includes stocks and options. This approach allows them to potentially benefit from both long-term growth and short-term market dynamics while managing risk and generating income through options trading. Earnings multiple recap. Earnings multiple are essential tools for evaluating stocks and investments. We discuss common types like PE, price to earnings, and PEG, price to earnings to growth. These ratios help assess stock attractiveness and growth potential. Your feedback is invaluable to us. It helps us tailor our future discussions to your interests. Consider which ratio is better with your trading plan: PE for valuation or PEG for growth. If you found this information helpful, please like and share it with others who may benefit. Subscribe to stay updated with more insights or trading and investing. We encourage you to ask questions, share your thoughts to help our content with even more informative and relevant to your needs. Thank you for being a part of our community, and thanks for watching.